All three major U.S. markets sank this week amidst concerns of a trade war, the Federal Reserve playing hardball, and labor markets beginning to crack. All around, it was a pretty terrifying week, especially for those who continue to insist that President Trump will not do the things he said he was going to do. Well, actually, it was probably more terrifying for those approaching retirement and watching their 401ks and investments completely tank. Again, all around, it was a pretty somber news week, except for mortgage bonds. So rather than getting political today, let's break down how this week's news will impact the real estate market so you can have an intelligent rather than charged conversation at happy hour today. He wasn't bluffing. Let's start with what was thought to be just a negotiation stance. Trump imposed a 25% tariff on all goods coming from Mexico and Canada and increased the tax on Chinese imports to 20%. The S&P fell 1% in response, the Dow dropped 340 points, NASDAQ increased by 1.4%. Something else happened too. Global money market funds saw a huge $61 billion influx of funds as investors sought safe haven in bonds, and mortgage interest rates improved. My boy Jerome Powell said the central bank is likely going to continue its stalemate, mentioning its current stance of neither hiking or cutting due to uncertainties surrounding Trump's policies not only on trade but government spending. That's fine. As I've mentioned previously, we don't really need anything from the Fed at this point. And when I say we, I should be clear that I'm speaking from the perspective of a real estate advisor focused on mortgage interest rates and their ability to boost affordability and unlock inventory. Which, by the way, my brother spoke to the OG Buffini this week on his podcast, and he said 5.875% is when we see inventory get unlocked. When interest rates hit that marker is when sellers will finally make their move and list their houses for sale. Something interesting to watch for. And then today is jobs report day. We were anticipating this with bated breath all week long. ADP numbers came in soft on Wednesday, boosting our hopes that the bonds would rally today if the jobs report was weak. Like I always say, it's not fun to be rooting for bad news, and I assure you, I am a human who understands the impact of the data we've received this week. In an effort to provide you with facts and how you can use them to shape your real estate strategy, I'll again remind you, I'm just focused on mortgage interest rates for the purpose of today's update. The jobs market showed only 151,000 jobs added, weaker than expectations, and an uptick on unemployment to 4.1%. Mortgage bonds aren't having a huge reaction to it right now, but to be honest, we're just glad they're not giving up their gains from this week because interest rates are now in the low sixes, and the R word seems to be looming heavier and heavier. Who wins in a recession? The real estate investor. I'll be back next week for specific strategies to be watching for in case a recession truly comes into play, how you can be ready to take advantage. Happy Friday, my friends. Take care of yourselves. It's tough out there.